So let's talk about what a possible recession means for fundraising, and then more importantly, what do we actually do about it? So we'll share some historical data, talk about where we might be going economically in the next few months, and then we'll actually just talk about some things that are very practical and what you can actually do about it to see that you might actually hit your goals and exceed them to make the most of the moment. So there is just a small note, small admin note. This is good for 1.0 CFRE credits. If you know what that is, it's professional development for fundraisers. And so at the end of the session, we'll drop in a survey, and you just fill out the survey, and that way we know you're here. And so just keep an eye on that. My colleague Amanda will do that at the end of the session. Okay, so today's agenda, we'll do some very quick intros. We'll talk about how fundraising might be affected by a recession. We'll talk about what to do about it. Pretty simple. And then some next steps in Q&A. So great. So quick intros. I know many of you, my name is Patrick. I'm lucky to be the co-founder and co-CEO alongside Jenny, pictured here. Should probably get an updated picture at some point. This was a few years ago, of FreeWill. And then we're really lucky to work alongside more than 200 lovely, smart, diverse, hardworking people, engineers, designers, fundraising experts, lawyers, a whole bunch of other stuff. Closing in on $6 billion raised, which we're excited about, and really just work hard on trying to make a lot of complicated giving really simple for donors and for nonprofits. So that's what we do. And then last thing before we get started, we really love you all and love sort of celebrating the fact that you're doing here. So we like to give away books whenever we get the chance. Not to everybody, because that is a lot of money and we're heading into a recession, but to 20 people. Basically, you fill out the survey, you give us your address, we select a bunch of folks and mail it out. This is a book I really like. We gave it away once before and people really enjoyed it, those who received it and read it, by a gentleman named Bu Srinivasan, who's an Indian immigrant to America, talks about the history of American capitalism from that view. And so if you want to know how did we get here in the modern economy, this is a really good book. There's some tougher themes in it, so just be prepared for that, because you have a 400-year history of American capitalism. So there's some violence, there's some slavery, there's some ups and downs, but it's the history of things. So feel free to check that out, or make a note in the gift if you're interested. Make a note in the survey if you're interested in that. We'd love to send it to you, and also would love to know what you hear about it. So make a note there. And then a little bit on you before we get rolling. We asked you how your mood is today, and a couple things. One, happiness is going up, and I assume part of that is first day of summer, Father's Day, some other things as well. But also check out this yellow line, right? This is self-reported anxiety or anxious, and you can see, we are higher than we've been since, let's see, January 14th. January 14th, 2020. Is that right? 2021, excuse me. So January, which would have corresponded pretty heavily with the January 6th insurrections. That sort of higher levels before that are around elections, and COVID spikes. And so people are the most nervous they've been in almost 2 years. And so just wanted to name that and sort of hold space for it in case that's you. If it is you, not alone, but almost 40% of folks feeling some level of anxiousness right now. So naming that. And then we asked, how confident are you hitting your goals this year? And the other thing we're seeing is, boy, this is the lowest we've seen. So maybe it's the topic, reminding people of some things to think about, but a pretty steep drop off in a month. So I just want to name that. And there'll be some work for us to do together to make sure we can actually hit them and make sure we're funding all the things that we're trying to fund here. So just wanted to say this and let you know what the rest of the sector is looking like. So let's quickly talk about recessions. So, what we mean as a recession is a significant decline in economic activity that lasts for months or years, right? That's what a recession is when we talk about it here. Sometimes economists, when they're classifying recessions, will say 2 or more consecutive quarters of declining national GDP. So, that tends to be, we often talk about recessions at a national level. And so those of you here from Canada and South Africa and Australia, you may have slightly different timing on some of your recessions in the United States. These tend to be unavoidable parts of the business cycle. No society has really cracked how to avoid recessions across the board. And it's part of the regular cadence of expansion and contraction that happens in a nation's economy. So it's a negative thing, but it tends to happen. This won't be the last one of our lifetimes. If we're lucky to live for a while, probably not the second to last or the third to last. These tend to happen with some regularity. Over the past 30 years, so if you're at least 30, you've lived through 4 recessions. So just taking a quick look at this. When we look at economic growth, you can see these gray areas are the length of recessions, et cetera. Now, just a quick couple notes here. See this red line, right? You'd say, well, why is that above 0? And anything below that counts as negative? Well, that's nominal GDP. So how much it grows overall, it's not accounting for inflation and some other things. And so, there's some areas that 4% is sort of keeping pace with inflation. And then you can see that these gray areas have differing lengths. And so 07, 08, 09, that lasted a bit longer than the dot-com recession, then the Gulf War recession, and then in the 80s, early 80s, mid 70s, you see some much more prolonged recessions as well. So how do we know we might be heading into a recession? Well, there are a couple of warning signs that economists use. One is what's called an inverted yield curve. This is the least important thing for you to understand, but we'll talk about it very quickly. Decline in consumer confidence, a drop in what's called the LEI, or leading economic index, a sudden stock market decline, rising unemployment, so things like that, right? And we'll just take a quick look here at what's happening right now. Well, an inverted yield curve, so we're now in inverted yield curve territory. It plots the market value or the interest rates of US government bonds from notes with 3 months and 10 years. Sometimes you use 2 years and 10 years, differing elements. But normally, yield should be higher on longer term bonds, right? You lend money for a little bit, and you get it back. That should be a higher rate than a longer term bond, or excuse me, a lower rate than a longer term bond because the money is locked up for longer. But a yield curve inversion is when the longer term yields are actually lower than the short term yields because investors predict uncertainty in the future, or they expect that the government will lower interest rates in the future as well to respond to a recession. So that's one thing. And if you don't get that, don't stress about it. Just know that it's true, that it's happening right now. Second thing is decline in consumer confidence. So consumer spending is the main driver of the economy, as many of you know. And surveys show a sustained drop in consumer confidence. It could be a sign of trouble. Once consumers stop spending, businesses start to contract and tend to do less spending themselves. That often leads to less sort of higher unemployment and other things like that, lower consumer spending, and a cycle goes on. And this is when consumers tell surveys they don't feel comfortable spending money in a variety of areas. So what you can see here is consumer confidence during the last 2 recessions. You see huge drops in 08, and then an incredibly precipitous drop in 2020, and now you're starting to see some declines as well. So we're still at a higher level than we were, certainly during the pandemic, but you can see this starting to drop pretty quickly after some sustained highs. So noting that. Other things we're seeing here is a drop in the leading economic index. What is this? It looks at factors, and it's a big combination of things like new applications for unemployment insurance, new orders for manufacturing, the stock market, a whole bunch of other stuff. And it combines them. Things like, are we breaking ground on new housing? Because the contractors and the builders are feeling bullish. And so it tries to predict future economic trends. And here's what we're looking at now from LEI. I know we're going through a lot, but basically trying to give you a quick overview here before we dig into the fundraising. So you see it, it dropped pretty precipitously around real GDP. Again, biggest gap here is 08, 09. Pretty sizable drop during early COVID, and now it's on its way down again. So we're keeping an eye on that. Other things we might be looking at is sudden stock market declines. So investors selling parts or all of their holdings, trying to be more secure in cash or gold sometimes. Rising unemployment, just a few months of steep job losses can be a big warning. So what we're seeing here is the Dow Jones is the lowest it's been since March 2021. You see this here. Unemployment, though, this is important. We haven't actually seen any shift in unemployment yet. So this can be a bit of a trailing indicator, or we may not see it this year or this recession. We'll figure that out. Just as a quick aside, why might unemployment still be low during a recession? Well, one possibility is that productivity has gotten so high that it's still useful to employ people at these productive rates, even with somewhat slower spending. So we'll see how that goes. Really quick walkthrough in past recessions, then we're going to dive fully into fundraising. So the Gulf War recession, these are the last 30 years, by the way. There's plenty of recessions throughout history, including the Great Depression, which was the longest one in US history. So Gulf War recession, you can see about 9 months, partly caused by spiking oil prices during the first Gulf War. Global oil prices more than doubled, made it really expensive to do a lot of other business things. Unemployment reached about 7%. The dot-com recession, sometimes thought of as March 2001 to June 2003. Technically, March 2001 through about that November in terms of that declining GDP. This was follow-up from the tech bubble crash of 2000. It was compounded by accounting scandals at companies like Enron. Some of you will remember the Enron scandal. And then the 9/11 terrorist attacks, which also hurt the economy and created a ton of uncertainty, alongside obviously a lot of other bad things happening there. And the impact is that about half of all dot-com companies survived. Unemployment reached a little under 6%. And so this was a little bit shorter compared to some of the other ones. Now, the big one, and this is what we're really hoping to avoid right now, and signs point to not being as bad as 2007 to 2009. This was caused in part by a bubble in the real estate market that exploded, subprime mortgage collapse. Unemployment reached 10%, which is the most in recent history. Large financial institutions, Bear Stearns, Fannie Mae, and others collapsed. Fannie Mae, I think, was bailed out by the government. Unprecedented bank bailout, fiscal stimulus package. And so this was the most challenging economic period of recent memory. And then the COVID recession was alarmingly short, but incredibly severe. So caused by a pandemic, obviously, you all were this is sort of a fresh memory, lasting only 2 months, the shortest recession in US history, but 24 million people lost jobs in just 3 weeks. And so you had sort of like catastrophic drops, especially in the service industry, and then things shifted and stimulus checks. And partly, there's some thought that the recovery of this one led to inflation. Government pumped a whole bunch of money, led to inflation, led to some increased risks as well, rising interest rates. And now here we are today. So a bunch of difficult choices at the federal macro level. And so, there may be some things to complain about, but I'm generally sympathetic to people dealing with a whole bunch of bad options in many of these cases. Okay, so that's what's happening in the world, and just making sure we're all aligned on that, because many of you will know some of that cold, but for some people it's just useful to have this refresher of how did we actually get here. So let's talk about modern fundraising and what it means in a recession. One thing we asked you all is, are you making changes to your fundraising strategy now in anticipation of a recession? And about most of you said, I don't know. So that's okay, 41%, we're pretty new here. A little under 40% said no, but 21% said yes, we are now making some changes. And if you're in the chat, would love to hear more about what changes you're making. We also asked people whether they're confident in the diversity of their fundraising streams to help you weather things like economic downturns. About a quarter said no, we're not, and then it's mixed between yes and we're not sure yet. So we'll keep an eye on this going forward. So before we dive into, one of the things that's highly correlated with economic giving is the stock market. And so particularly looking at the stock market in the past year, we see this, it's down 10% over the last 12 months, certainly down a little bit more from its peak. You can see that peak in about January 22. But an important piece of context here, and we'll get to why this is so important later, is that we're still up 42% over the past 5 years. And so some of the news will often compare current stock market to that one day when it was the highest it's ever been in January of 22. But realistically, when you take a sort of random day and compare it to now, oftentimes we're in better shape than it might be. All right, so now we are digging deeply into fundraising. When we look at charitable giving year over year, and we compare it to, say, the S&P 500, this is adjusted for 2019 dollars, and total charitable giving, again, this is also adjusted. So let's make sure we're doing apples to apples. Here's what you can see, and we'll spend a little bit of time with this graph. The orange line is total charitable giving in billions. The S&P is the gray line. So what do we see as a general trend? First thing to note is, hey, generally good news in both the stock market and giving, and actually giving, generally strong news overall. I mean, giving is just up across the board year over year over year. Pretty good. Now you see a couple of moments of giving drop. Let's sort of look in at 2009, 2010. But also it doesn't drop as precipitously as the stock market did. And so that's pretty good news as well. Go down to, look at that 2000, 2001, 2002, where you see a really big drop in the S&P and a general flattening, maybe a slight decrease there around 2002. Again, 2008, huge drop in the stock market, a drop in giving, but not as significant. You see a really slight, actually drop in giving around 2014, 2015, despite a large increase in the stock market. But that may be statistical noise or one or two really large gifts because you see how big that gap is from 2013 to 2014. So this is just the history of our industry and pretty interesting to look at. When we look at year-over-year growth, you can see what this looks like in these recessions, right? So we've boxed out the recessions here. In 1990, you had a pretty significant drop, 5.7%, and then a basically meaningless drop, 91. In 2001, you saw about a 3% drop and a 1% drop after the recession as well. And then in 2008, you saw the most precipitous drop in giving, 2008, 2009. So that is probably the low watermark in what could happen. My guess is that we're much more likely to see these 2001, 2002 numbers where we have a somewhat slight decrease or about staying even. So some interesting data here. But as we think about what is really worst case scenario, it's probably a 12% drop. That's pretty unlikely. What's more likely, it might be a 2% drop or a 3% drop. So we see that giving decreases. Overall giving across the board grows at a roughly annual rate of 3.3%. This is pretty good. 10% growth every 3 years. We're pretty happy with that. During years of economic growth, average giving has increased by 5%. So again, pretty awesome. I mean, first of all, congratulations to everybody here who made that possible. Not a lot of industries are growing at 5% year over year. During economic downturns, the average giving has decreased by just 0.5%. So this really matters as well. The Great Recession saw total giving drop by 7.4 in 2008, another 8% in 2009. I want to note very quickly that these stats are from different sources, so they don't perfectly match up, but they're directionally similar. So if you're sitting here saying, it's not exactly what I saw in the previous graph, just note that the sources are a bit different here. So you can get directional value. Thank you, IUPUI, by the way, or sorry, IU, Lilly School of Philanthropy, helping out with a lot of the data here. When you see what this total giving looks like, again, this is another way to look at it, and you can see the ongoing, generally up, a bit of a drop here, a bit of a drop in 2017, which is sort of unexpected, and so on and so forth. So that's our first insight. We may be looking at a small drop, but it's unlikely to drop in half, right? So make sure that your executive directors and your board know that. Insight 2 is donors prioritize what's important to them. So in 2008 and 2009, in total, giving got by 15%, not each year, cumulatively. Giving to nonprofits such as food banks and essential social services actually grew by 10%. So what we're saying here is this is not preordained, right? That certainly some organizations are thriving. And you can imagine that those food banks and social services are not equally distributed. So some of them might have grown by 25% or 50% or 100% as well. Individual motivations, as you probably know, for charitable giving go beyond finances, including personal values. And so this is some of what we saw as donor behavior. Insight 3 is that percent of income to charity is fairly consistent. So American households spend most of their money on housing, transportation, and food. But in recent recessions, there aren't significant shifts in the share of income spent in each category, including giving. So all this just pushes down a little bit. Average income donated to charity ranges from 3 to 5% of annual gross income and tends to stay there. And so why does giving go down in recessions? Well, there's just a little bit less money floating around. And so it's not showing that people suddenly become less generous. They just sort of give the same portion of what they have. Oh, fascinating. Michael McKelvey hops in and says, greatest participation with giving in our country was during the Great Depression, which is really, it's a great fact. Thank you for sharing that. You can also see how total contribution as a percent of annual gross income changes, and that both the highest, the wealthiest folks tend to give a lot more, but also the folks with the least amount of money tend to give a decent percentage of their income as well. So some really interesting data. Don't write anybody off. Participation rate does decline a bit. Roughly 2/3 of adults give to charity each year. It declines during recessions. From 2000 to 2008, it dropped from 66 to 65%. But after the Great Recession, it declined to 61% and is never actually fully recovered. So in 2016, for instance, it was only 54% of folks giving to charity. So some really interesting data there. And then the other thing to note is that not all donors are impacted the same. So economic shocks are felt differently based on socio-demographic characteristics like age and gender and race. Households more strongly affected by the Great Recession experiences a slower recovery, larger declines in charitable giving, et cetera, right? And so even different industries, right? So your tech donors might be down a little bit, but the folks working in oil and gas might be up, right? There's all sort of variety here. And it's easy to think of the economy as a monolith, but actually it's just a collection of, a billion different data points going up and down at one point. And so let's make sure that we're not painting an overly broad brush for our donors as well. Okay, so now let's dive in on what do we actually do about this? We know about recessions, we sort of understand what's potentially coming. We've seen what happens into giving in previous recessions. Now, what do we actually do about it? What should we change for the next year? The first thing to understand is making the most of new donor psychographics. So I would ask that over the course of the next week, if you listen to the radio or some podcasts or watch TV, you start to listen to the commercials. Now, you don't normally, you might zone out a little bit, but I really saw this come up over the last month. And just as an example, I was listening to a podcast the other day, or I guess the radio, and I think a Dodge Ram, but a pickup truck commercial comes on. And they say, the commercial is basically, in moments like this, we really need to be focusing on savings. You can now get 10% off a new Dodge Ram. And this is the sort of messaging that's going to be happening, right? People are still marketing. Over the next 12 months, the economic downturn and recession will be the dominant news story, along with the midterm and Supreme Court cases. And a lot of the commercial marketing that people see will be reinforcing this idea of saving money and being smart with money, right? So that will be a shift in the way that donors are thinking in 2022 compared to last year, right? Times are good. We have a lot of money. Let's think about where to give it. Now, this message of how to be smart with your money is going to be in major newspapers, on the morning shows, but also in the marketing commercials. And so people will be really drilled with this message repeatedly, mostly not by folks like you. They will see hundreds of things like how to be smart with your money articles. This will be very, very front of mind. And so we can use this to help hit our goals, right? We have to understand where donors are. And it's really two giant pieces here. The first is we're going to start framing gifts that are tax smart or smarter ways to give. This will draw the attention of donors who are already in the mindset of thinking about this. There are two big categories of gifts that we think of as tax smart. The first is appreciated asset giving, primarily stock and crypto, because these gifts avoid capital gains and typically get a full federal income tax deduction. So you just save more money in taxes by giving this gift as opposed to something else. The second are gifts like qualified charitable donations for older donors or workplace deductions, often for younger donors, that give pre-tax money. So you never get charged on it at all. And that can be smart, especially in a country where the current tax regime means that only about 10-ish% of Americans are itemizing deductions. So we always talk about these, get a tax deduction when you give, but a lot of folks are sort of below the standard deduction and actually not gaining a lot of benefit from that. And so these other ways to give do actually end up being much smarter as a way to donate. Also, and we'll talk more about this in a second, but these gifts just end up being much larger. And so you really, separately from a recession, you always want to be pointing donors this way, but they're going to be more receptive potentially than they were a year ago. Now, why is this? Some of these gifts tend to take just a little more effort, not a lot, but a little more effort. And the trade-off of time and money, or effort and money, is quite different. I remember, when my grandmother passed away, we were cleaning out her house, and in the basement there would be boxes, and the boxes would just be labeled milk cartons, and she'd have a dozen milk cartons, thankfully empty, in there. But it wasn't, she wasn't senile. She was an incredibly smart woman, and what happened in her life is that she was born on the day the stock market crashed in 1929. So she was born into a middle-class family that became a poor family the day she was born. And what we saw throughout the course of her life is that she just valued money over time and would always do things that took a little bit more effort in order to save a little bit of money. And historically, in sort of good times, people don't actually behave that way. But now people are operating more like my grandmother, where they'll put a little bit more effort into doing something that saves them money. And in this case, actually ends up with a much bigger gift. And so you can sort of think about my grandmother, other folks that might have that weighting of effort versus money or time versus money to a different degree than some others. And so we'll start to see more people act that way in this recession. The second thing we're seeing is that you really want to get specific about what people are funding. And just as a quick example here, over the weekend, one of my friends who's running for a local office out west called me and asked me for money. And he asked me for a reasonably large amount of money, and I basically said no. I said, that's too much money. I can't do it. Maybe something else. But I'm going to walk you through this and think about what he could have done to be more effective. I think that gone are the days when people just say, "Oh, I've got so much money. Let's make sure we're giving out of it, or giving some of it away." What you're seeing instead, if someone asks for $10,000, that sounds like a lot of money, right? You say, "Hey, give me $10,000." It sounds. Say, wow, that's more than we're willing to spend right now. Times are a little tight. We're really thinking about how to be a bit smarter. But if you said, hey, can you give us $10,000 to provide 2,000 meals to people who need it right now? Suddenly this sounds like a real bargain. And what we're looking for is, are we anchoring to what is possible with a gift, or are we anchoring to how much does it cost me, right? This is a huge divide. And so again, if my friend had said, I need $1,000 or I need $2,000, and it's going to pay for this amount of mailers to these number of people who are swing voters, and it will increase my chance of getting elected by X, and say, okay, maybe I can do that. But when it just presents as an amount of money, suddenly it feels very off-putting, and I can't, I just don't feel comfortable spending that much money right now. And so now when we're looking at our asks, are we anchoring, put yourself in the donor's shoes and really, really ask, are we anchoring to how much this is costing me? Or are we anchoring to what happens with the money? And the more specific we can be on what happens with the money, and the less it will anchor me to how much it costs me, and the more generous you will be. Now, this is okay if money is going to a general fund. Sometimes people get a little twisted here. There's an organization called the Heifer Foundation, which does amazing work, and I believe grew to about from $1 million to $100 million in revenue by sort of helping people give very specific types of animals and other things to families that need it. And that's an amazing model if you can do it. But it's okay to say something like, $10,000 or $1,000 will help one student finish out the last semester, or it's equivalent to helping one student finish out the last semester and make sure she's ultra prepared for the job market, right? Something like that. And being super clear about what people are funding suddenly really shifts these conversations. And so I would really look at the conversations you're having and some of the email or direct mail asks you're making, and really say, are we anchoring on one, how much it costs me, or are we anchoring on two, what we do for the money? And it will feel like a bargain to do some of these things that you can enable with donations. But if you just ask for a large sum, you'll get more no's than you used to. So this is a really important point. All right, one more note on psychographics. This is something we will cover. Actually, our next webinar in a couple of weeks is on writing and effective writing. And one of the things that's my favorite point in writing is that framing things as an opportunity to donate and being exceptional, maybe unprecedented, or a particular moment, a particular crisis, changes how people mentally budget the expense. It removes the comparison with disposable income, right? People are sort of doing this mental budgeting and they're a little bit tighter with it than they used to be, but it increases charitable giving. Remember that food banks and others saw an increase during the Great Recession, highlighting the possibilities of emergency giving. Now, if you're a food bank, obviously you're doing really important work, keep doing this. If you're not a food bank, you can really think about how to frame this. Hey, we're trying to make sure, we're trying to provide extra resources to kids in this moment. It's a really sort of difficult year as people are catching up. Just this year, can you do X, right? One of the things that people do is when they have an annual giving year, some of you have this at your college, your university, your hospital, whatever, you have this sort of annual giving day. Now, it's tempting to say this is our annual giving day. We like traditions, whatever. Saying that it happens only once a year compared with annual, which feels, regular, predictable, only once a year feels exceptional. Now, these two things mean exactly the same thing, but only once a year will generate you more giving because it feels like, this is a special occasion, as opposed to annual, which, I think, maybe I'll do it next year as well, right? Remember, exactly the same thing. Economists would tell you there's no difference. The psychologists would tell you got to go for the first one and you'll generate a lot more giving. And psychologists often tend to be right over economists because humans are not perfectly logical. A couple more things. Do not let the news fool you. So we showed you that graph with stock giving, but this is really important. There is, and there will be over the next year, lots of news about asset prices, especially stocks and crypto. Should we be asking for non-cash asset gifts in a bear market, right? So these things are down. Should we still be asking for non-cash assets? Maybe a quick poll in the chat. Yes or no, is this a good time to be asking for stock gifts or crypto gifts? Stocks are down 10%, crypto's down a bunch. What do you think? Okay, this might be a little bit of a leading question. So we're getting about 90% yeses and about 10% absolutelys. So why is this? The answer is yes. So that would be my answer. You all get your own answers. Here's some historical context. Crypto prices today are 110% higher than they were 2 years ago. In fact, they're 5% higher than they were on Friday. Stocks are up 40% over the past 5 years. This is what stocks look like over time. Pretty remarkable. This is what, Tesla, you're hearing a lot of news about Tesla crashing. Look at Tesla stock over the last 5 years. So if you bought Tesla in 2017, you are wildly rich right now. Look at crypto, a lot of ups and downs, okay? There's a really big rise. Wow, 2021 was a great year for crypto. And yet, you follow these lines across the board, Bitcoin's at 20K, that feels like horrific. It's twice as high as it was in 2020. It's about 4 times higher than it was in 2019. So you have so many assets that have been appreciated, and the news, it's not inaccurate, but it's not always truthful, right? Because what we talk about, let's say crypto down, 70%, 60%, whatever, what they're really doing is they're picking out this one all-time high where it lasted for a second and a half. And if we are going to pretend that everybody bought their crypto at that second and a half, that's just not accurate. And so it's a really easy thing to miss, right? Crypto is exceptionally volatile. Stock market tends to be volatile as well, but both of them have had a long-term trend of going up. So many people who bought them do have some stocks that are appreciated. You might have some crypto that's appreciated, but many of those assets are wildly appreciated. And now that we're being smarter with money, those are the things to give. So make sure that folks know they can accept stock, crypto, DAFs. We'll talk about DAFs in a second. And remember that one of the things that's actually depreciating, straight line depreciating, or being valued less is cash, right? Cash is becoming less valuable with inflation. You should be actively turning donors towards gifts that are not cash, right? So cash is the only thing that is less valuable today than it was 5 years ago. I mean, it's really remarkable. And absent a period of deflation, which would be a little catastrophic for the economy, it's a really bad thing to happen because it means people just hold their money. They don't want to spend it because it's going to be more valuable tomorrow, and then the whole economy, risks collapse. Cash is the only thing that actually is worth less across the board than it was 5 years ago, and so really, really, really important to double down here. So you want things like links to stock giving, crypto giving, give from your DAF on your donate page as well as your ways to give page. Make sure that people have this option. All right, third strategy here. I'm glad to see everybody's aligned on that. please do not forget about donor advised funds. So donor advised funds are specifically earmarked for charity already. You cannot go back and spend them on day-to-day expenses. More than 10 billion was given from Fidelity's DAF alone, a 13% increase from 2020, a 41% increase from pre-pandemic. So there is a ton of money sitting in DAFs right now. This is only Fidelity, right? 10 billion. Probably looking more at like 30, 40, 50, maybe even $60 billion coming out of DAFs in 2022. This is again, Fidelity only because they have the most recent numbers here. You look at the growth of DAFs from 2012 to 2020, 2021. I mean, it's 7x, 8x, something like that. So really astounding growth. This money is already committed to charity. This is a good time, right? So DAFs did not exist in 2008, 2009, and they may be a boon now. We said during the early pandemic, let's just say we saw during the early pandemic that DAF donors will accelerate giving during crisis times, and this can be done again. So if you are if you're in a moment of great need, you want to sit down with your DAF donors, you want to lay out the landscape, be really clear, and then go back to that, hey, $1 million gift right now can do this, and a $500,000 gift can do this, and be super specific. Don't just say empty your DAF, say this is what we can do, and make sure they can also give you non-cash assets. So this is not a major point today, but remember that massive rise in DAF giving, 65% of stuff going into DAFs is not cash. It's mostly publicly traded stocks, a little bit crypto, a little bit privately traded stocks. But people are giving to DAFs because they don't know that they can give you this directly, right? Everybody loves you more than they love their donor advised fund. Just, that sort of, people appreciate it, but they don't have a really deep emotional connection to Vanguard's charitable fund, but they do to you. And so it's imperative that your DAF donors also know they can give you directly, and that will speed up some of the giving to get you through some of this tough time. A couple other things to note. Remember that planned giving tends to be non-cyclical because human mortality is not necessarily tied to economic standards, right? So planned giving is on a sharp upswing. Why is that? Not because of the economy, but because of demographics. And we've talked about this plenty, but the great wealth transfer is going to pass on literally trillions of dollars into sort of the hands of recipients, $70 trillion by some estimates, and potentially $10 trillion into the hands of charities. Human mortality, again, doesn't slump or speed up for the most part during economic cycles. And for many organizations, planned giving allows you to continue to thrive during the economic tumultuous times. And so this is a thing to really pay attention to. Some of these large bequests are starting to come in the great wealth transfer. And this is a real time to continue with this. For many people, it's just the largest gift that they'll ever make, almost entirely. A lot of IRS data shows that it's a typical bequest is 3 times larger than your entire lifetime charitable giving all the gifts you've given everywhere. And so just to put that in perspective for a moment. All right, 2 more points before we wrap up. One is donors prioritize what's important to them. And so now you want to reinforce why they care about your mission. You are more likely to succeed over the next 18 months, getting through a possible recession by generating larger gifts from the same donors than by expanding your donor base. Remember, participation tends to contract a little bit, but your big donors who are there, there's a really strong moment to up-level them across the board. The fastest way to get a larger gift from the same person is by changing the way that they give. From cash to stocks, from cash to QCDs, from cash to crypto, from cash to real estate. Across the board, we've seen it. Excuse me. So this is really, really, really important. And then one final note before we get to a couple of resources and moving on from here. Remember that it is far, far easier for an organization like yours to expand revenue than to cut costs. It is always easier to raise 5% more than to spend 5% less. The same is certainly true from 25%. There will be more competition for donor dollars, and so you will need to boost your efforts. For every dollar spent on things like fundraising bequest gifts, you can expect an average return of nearly $57. For everything on major giving, you can receive a return of $33. This tends to go down a little bit for annual giving. But across the board, you are going to, meaning you, the individual on the call here, are going to power your organization through this, right? That this is the moment where fundraising gets challenging, but more important than ever. And so I hope that you know that most of the country should be really grateful to folks like you who are playing a key role in getting our most treasured institutions through this. And so a really big thank you. And we are obviously here to help you as much as we can. So hope you feel ready for this, but we think you are. All right, so a couple of resources as we wrap up. One is please fill out this survey. My colleague Amanda, who's joining us today, is going to drop in the chat. Part of that is we will give away this book, which is honestly just a fascinating read. And if you think times are hard now, wait till you go back through 400 years of history and you'll realize that, yes, a minor recession is going to be a small blip in our lives. Make a note in the survey if you'd like a copy, tell us where to send it. Other things in the survey are crypto fundraising guide. A lot of people have asked about how do we do this well? What are our gift processing things? How do we actually make sense of this in a world of opportunity, but maybe a question about security? And so feel free to make a note there. And then also, if you're interested, you're more than welcome to get a one-on-one demo of our estate planning tools, which actually are going to likely see a big rise as people are looking for more things to do for free. It's #1 estate planning tool in the country. It nudges charitable giving in a big way and generates about $6 million in requests every single day, which is pretty awesome. You can also, if you're a larger either regional or state or national organization, partner with us as a feature ship, which means that every time a relevant person is making their estate plan, that you're actually front and center while they're making the charitable giving decisions. So that's pretty cool. Also tools around stock giving and qualified charitable distributions as well for older folks, which is really important, and crypto giving as well. So my colleague Alyssa is doing a group demonstration if you want to join that instead on Thursday, July 7th. So feel free to note that as well. She's pretty awesome. Okay, so we'll do a quick break here for you all to fill out the survey. I'm going to read the Q&A and we'll prioritize some of the most common questions and then we'll go from there. So thank you, Amanda, for dropping in the survey. That's there already. So click on that if you don't mind, and I will be reading some of the questions. All right. Okay, we have a bunch of good questions here. First question from Gideon says, can you contrast the definition of a recession with a depression? So a depression is not a formal term the way recession is. Usually depression is a longer term, timeline, deeper drop in GDP. We typically think of as the Great Depression as the most notable of them. There is a joke that economists make, which is when your neighbor loses his or her job, it's a recession, and when you lose your job, it's a depression. But there's no clear answer there, and so signs point to this being a recession and not a depression. Great question. Do hiring challenges that businesses are experiencing have an impact on this potential recession? Corey, it's a really interesting question, and I may not be fully equipped to answer it, but for the most part, there is still high competition for labor, and yet there is some risk of unemployment. Now, why might unemployment be lower now than it used to be? Well, one of the causes of unemployment is not enough jobs, right? So we can all sort of inherently get that. But another cause of unemployment is friction in the labor market, meaning there is a job that you want, and there is someone out there who wants to hire you, but you don't know about each other. And that might be because they're not in your neighborhood, or it might be because you haven't found them. And so one of the blessings of the internet is, things like LinkedIn tend to be a little bit annoying, but they tend to be really good at lowering the friction in the job market. And so it's easier for folks to find. Now, also, two other things are happening. One is, the rise of remote work allows you in Wisconsin to find the job in North Carolina that can't wait to hire you. And that just wouldn't be true, right? If you were in a recession in Wisconsin in 1983, and there wasn't a job for you, and you weren't ready to move because your whole family was there, well, then you were unemployed. And now that friction is a little bit lower. The other thing is that we actually see increased urbanization. And so even for geographically tied jobs, more people are in a place where they can actually get to a job, even if it's a bit of a commute. And so that's a couple of shifts that we're seeing at a macro level that might lower unemployment right now. There was a question around, does charitable giving include bequests in some of the slides around slide 36? It does. But remember that bequests are often, sometimes they're sort of skewed a bit by some major gifts because bequests are so large. So you'll see a little bit of noisiness. In the overall trends, it's better to look maybe at every 5 years combined. But also the most important factor in driving bequests long-term is demographics. And as baby boomers age, you're about to see a massive windfall of bequests for charities, probably starting in a few years where it's really starting to pick up and then going on for the next 20 years. Great, so a couple of crypto questions. Can you expand more on crypto? Are people giving crypto at higher rates now? TBD. One thing we're seeing is that there's widespread adoption of crypto over the past year and a half in particular. Those of you that sort of watch TV, see billboards, will see a stunning number of crypto ads. I think I mentioned this on a previous webinar, but I'm a big New York Mets fan. Watch baseball with some regularity. It's a good break from running a company and doing all this other stuff. And one of the things that's really striking is on the left shoulder of the umpires, there's now an FTX sponsorship patch. And FTX is just a crypto exchange. And you're seeing a huge number of people buy it for the first time this year. So my guess is that you may see a couple ebbs and flows, but that Q4 and giving season will see a lot of crypto giving, especially from your younger donors. And so it's a really big key. Seth notes that crypto.com arena, those of you I think know where the Lakers and maybe the Clippers play as well, that got, the sort of famous Staples Center got renamed crypto.com arena as well. Good questions. Sarah says, we aren't allowed to position anything as tax advice. Can you advise on ways to skirt that with the strategy? We would say, Sarah, a good way to talk about this is a lot of other donors are choosing to do this for tax reasons. Feel free to investigate those. But we're seeing more people give because of potential tax breaks. Go learn more about that on your own. And positioning it as what other people are doing as opposed to what is best for your personal tax situation tends to be very, very effective, and I think would fly with your board or anybody else. Alexa says, do you have more tips on how to integrate specific giving opportunities onto annual fundraising? The approach in my institution, which is a pre-K through 8 school, has been to encourage unrestricted donations as much as possible. So Alexa, a lot of this is about the framing, right? So you don't necessarily have to say, buy chalkboards for 10 classrooms. What you can say is, where does your money actually go? Well, $100 is the equivalent to buying a new chalkboard, right? $1,000 is the equivalent to training 2 of our teachers so they can improve their methods. And you talk about this equivalent to sort of give people an idea of how valuable their money is, but you don't have to say we have a specific fund only for teacher training and you can donate to that. So this is a really important difference, and I'm glad that you asked it, because certainly, general expenses, especially at a hospital, university, a college, a school. It's a lot of it, and it's impactful giving. But helping people understand some of the equivalents will be really useful. Ray asks, how do you get involved with DAFs as a recipient? Are there particular donors to talk to? Gray, it is largely a bad use of time to go talk to Vanguard or Fidelity. They sort of mostly work for the donors. They don't really want to hear pitches from you all. What is useful is when people are giving you DAFs, go follow up with them and make sure we're noting that in our database. And then two, when you are doing surveys, or even on a checkout page, you might have a little checkbox that says, I have a donor advice fund, I would like to hear more about DAF giving, right? Things like that, so you can start to identify them. But the path forward with DAFs is largely through the donors, not through the DAF. The one exception here is DAFs coming out of community foundations. And so if you're a local charity, particularly a social service one, or similar, making sure that that foundation knows what you're up to is really useful. And we've done a lot of work on DAFs in the past, so happy to revisit that topic at some point. All right, couple more. Let's do one more question, and we'll let everybody get back to their busy lives. So Allison says, last question is, would you talk a little bit more about point number 5, which is changing how a donor gives a gift, as an example from cash to stock. So just to reiterate, the point that we're making is the single most effective way to get larger gifts from the same people is by changing the way they give, from cash to stock, from cash to crypto, from cash to qualified charitable distributions. Plan giving is obviously useful here, from cash to real estate. And why is that? Well, there are 2 reasons. The smaller reason is that most of these have outsized tax benefits compared to giving cash. So if I give cash, I get a federal deduction for the amount. If I give appreciated stock, for the most part, I get the same federal deductions, and I avoid capital gains. So I'm just better off. That's one. Basically same math with crypto. Second thing is, more importantly, and a lot of crypto donors that we see don't care about taxes at all. They don't even ask for tax receipts sometimes. When I give out of my wealth, I'm anchored to a different psychological point than when I give out of my income. When I give out my income, it's X amount. Giving away 1/3 of my paycheck that week feels like way too much. Giving away 1% of what I have in savings feels way easier, and that may be a much larger amount of money. There's a famous experiment, famous in our world, maybe not that famous across the board, where somebody stood outside a grocery store, and for half the people said, hey, what's in your wallet right now? How much cash do you have? What's in your wallet? Second one asked, say, hey, what investments do you have? And then that's it. They sort of asked that question. People went to the grocery store. On the way out, they said, hey, can I see your receipt? How much did you spend? And people spent about 35% more when they had been primed with the investment question, because they were anchoring on their wealth. Now, these are same people doing the same grocery run, and suddenly vastly different amounts of money. And so, it's an interesting thought. If you're running a grocery store, do you have a bunch of ads for financial advisors outside to prime people about their investments? But it's interesting data across the board. All right, so let's wrap up there. Again, a huge thank you for all of you for a couple things. One, really pushing yourself to learn more, to advance your career, and to really advance your organization. And second, just for all the hard work you're doing this year. It's wildly important. A ton of confidence that you guys will pull it all through. And obviously a lot of people in your organization are counting on you, but most of the people you serve are counting on you as well. And so thrilled to be able to support you in some small way, and delighted to spend time together. Quick note, in 2 weeks, we are going to have a session on effective writing and a bunch of updates for this year. So feel free to join that. And then if you have any other creative ideas to share, just if you need anything at all, just drop us a note. Thank you again, and have a wonderful weekend, and happy Father's Day again to all of you dads out there. Take care.